Going. And I'd like to welcome you all to Building a Startup Budget. We have one of our SCORE Boston volunteers, Mike Salmon, with us here today. And he is going to be our presenter for today. I'm going to go to the, yep. Well, as you can see, Mike has two careers, one in manufacturing materials for composites and the second in management consulting, focused on competitive strategies. And he's been a SCORE mentor since 2015, and he's been a valued volunteer for our chapter. I just want to tell you a little bit about SCORE as we get things going. SCORE has a couple different roles in the small business community. One is offering training, which we have just about every subject you can imagine this fall, and they'll continue up through into the holiday, up to just before the holiday season, and then we'll restart again in January. So I encourage you to check out either the website or watch for our newsletters. The other thing we have is fantastic information on our websites, which is at the bottom there, and I'll put those websites into the chat as well. The most important thing, though, that SCORE does is mentoring. Our mentors are volunteers that have lots of different experiences and expertise and knowledge that they want to share with folks that are thinking about starting a business, in the process of starting that business, or already have a business. You can come to us at any stage along that small business path. You do not have to have your business already established. You do not have to have a business plan already established. We're there to help you from the very beginning on through the growth of that business. I encourage you to reach out to us. You can put a note in chat if you'd like a mentor today, and I'll make sure someone reaches out to you. We are going to use the Q&A tab for today's webinar. That would be for any questions you want asked to the presenter. It allows me to keep track of those questions and not lose them in the chat, because sometimes the chat starts getting a lot of information going in it. So I want to make sure we get that information to you, or get your questions answered. So if you could put those questions into the Q&A tab, that is really helpful to us. So I guess that's all I have on the SCORE intro side of things. So I'm going to go ahead and turn it over to Mike.
Okay, thanks, Teresa. Thanks to all of you for coming. We're going to talk about building a startup budget, and we're going to do that for an example that I think will be useful. And then you'll get the templates that we're using here from Teresa after the webinar, and a copy of a PDF of the presentation. But please do ask questions as we go along. We don't have a huge group here. And so that's good, because that means we're going to be able to give plenty of attention to any questions that you have. And so let's talk about money. Okay, let's talk about some of the definitions, some of the terms that people use when you're building a startup budget. And sometimes people get a little bit confused between revenue and profit, or sales and what's left over profit. So let's make sure we all have the same definitions. Revenue or sales, the words are pretty much used interchangeably, are what the customers or clients pay. And net revenue or sales is what's left if you have returns or allowances, or if you have a coupon for a service or a product that you then honor and give a discount for the product. So that's the sort of top line of the financial statements, is how much money is coming in. Expenses or costs are how much money is going out, what you pay to run the business. And there are different categories of startup costs, and we're going to look at these in some detail. So there's, different categories of expenses, and we're going to look at these in some detail. The startup costs are what it takes to get the business going: equipment, build out, legal, build a website, anything of that sort, all the things that you need to do in order to get going. The fixed expenses are the things that continue. If you're renting something, or you have a website that's being hosted, you pay for insurance, you pay for telephone, anything of that sort that continues regardless of whether revenue goes up or down. As long as you're in business, those expenses will continue. and they'll grow. Fixed expenses will increase as time goes on if you get bigger. But the key is they're pretty steady, and you have to plan for that baseline, even if there's no money coming in right at the beginning when you're first starting up. And we'll see how that affects your business and your planning a little bit later on. Variable expenses are labor, including your labor. That's really important, to include your time, the value of your time. A lot of people forget that when they're putting together their initial workup of finances. Any parts and supplies that you have to buy, inventory, if you're selling a product, those are variable expenses because they go up and down in pretty much direct relationship to revenue. So you sell more product, you need more product to supply. And if it's a physical product, then you need to buy that. If it's a virtual product, perhaps not so much. But then your fixed expenses might be the licensing that you're paying for something. So they're variable because they go up and down depending on revenue. And after you take those expenses and fixed expenses and deduct them from revenue, that's what's left over. And profit is what's left over after all the expenses are paid. And so let's make sure that we understand that that's the final number. And you can have actually a pretty small profit at the end of the month or the end of the year, and that's okay as long as you're paying yourself. And for small businesses, for startups, that's very typically true. The owner, the proprietor, will take out most of the money that goes in, unless you need it to reinvest in order to grow. And we'll talk a little bit about that. But really, this is about building that startup budget, about what you need to get off the ground. So why bother? Well, it's really important to figure out whether the business will enable you to reach your personal income goals. And that's a key. If you're starting a business, there's a reason for it. Presumably, you want to do it in order to earn a certain level of income. And you may have a target of $50,000 a year or $500,000 a year, whatever it is. Whatever your goal is, the key is to figure out whether the business will enable you to reach that goal and to be able to draw an income out that you feel you need. And you'll be able to figure out how much money you need to start up or expand in order to build that business. We'll give you an understanding of the financial risks and rewards. I will identify development and startup costs and ongoing expenses as separate categories so that you understand how much money you need to get off the ground and then what it's going to take to continue to operate the business. And if you're getting some money from a nonprofit lender or a bank or family, very often they want to see an ongoing budget projection, a startup and a budget projection, because they want to assess the risk to them. They want their money back if they're funding you, unless it's a gift. And you want to provide a plan to help you guide your own decisions and monitor your results. How am I doing? You can measure yourself against your startup plan. And if you need to change something, change a projection, for example, for future cash flow or for the future amount of labor that you need. That looking back at the way you've built your plan and modifying that plan as you go along is a very big help. So a lot of people say when they first go through this and they look at the spreadsheets that we're going to send you, these look really complicated. I don't think I can do this on my own. I don't understand all the figures and the math. Don't worry about that. The spreadsheets, the templates will do the math for you. We're going to walk through them so that you can understand how to use them. And you really can do this. And there are lots of SCORE mentors in Eastern Massachusetts, Rhode Island, and all of Massachusetts, Rhode Island, and really all across the country. Lots of SCORE mentors who can help you do it. Each SCORE chapter has people who understand this particular way of building a budget. So certainly you can go out to ask for some help. and get some detailed help with your particular startup. And we have people who are familiar with all kinds of businesses. So whether it's a virtual online business or a bricks and mortar business, manufacturing, whatever it is, you can get some help from a SCORE mentor in putting together this projection that we're talking about. So we're going to take an example of Anne's nursery. Anne is going to produce specimen trees for people's lawns, shrubs and vines. And she's looking to get to projected sales of $710,000. And we'll show you how she gets to that. And she's besides selling to landscapers, she's going to sell to florists and to consumers. And so let's see what she needs to do for those different categories of sales. We're going to give you a look at 6 different worksheets, and they will tell you about how much money you need to start up. They're going to walk you through the salaries and wages that you'll need to pay. They'll walk you through the fixed operating expenses, the expenses that will go on as she's getting started as soon as she opens the door, the projected sales forecast, and a second one on projected sales, and then cash receipts and disbursements, a cash flow statement. And those worksheets will work in Excel, they'll work in Google Sheets, or in Apple's numbers program. So pretty much anything, any application, any spreadsheet application you have, you can import the template into that and it should work. Okay, let's get started. So startup funds, what does Anne need in this case for a plant nursery? Different kinds of businesses, different startup expenses. So this spreadsheet should help you understand how much you need by breaking it down into what it's going to be used for. And you should be sure to include whatever startup inventory you need, stuff on the shelf in order to open the doors and get going. Whatever labor costs you're going to have getting there, getting to the point where you can open the door before you make that first sale, what you need. Well, let's go through it. She has real estate. She has to buy some land in order to grow her plants or perhaps rent it. She's going to need buildings, and that's probably a rental. She may have to do something to improve that building. Those are leasehold improvements. She'll need some equipment, some furniture and fixtures, delivery vehicle, perhaps. Those are the fixed things that she has to buy, the things that will last as long as she's running the business. And then there are some out-of-pocket expenses that she's going to have, pre-opening salaries and wages. We'll see about that. In this case, she's not figuring that she needs anything for that. She's going to put her own labor into it, and okay, she's going to be doing that for free. But she'll need some insurance premiums that she'll have to pay ahead of time. She has to buy inventory. She may have some legal and accounting fees and utility deposits, maybe a rent deposit, supplies. These are the categories for this kind of business. What you need to do if you're starting a business is to think about the categories in your business. And we've taken a business that has bricks and mortar, or at least land and a building and a place to grow plants on purpose rather than an online business, because we want to make sure that any of you who are starting up a business that has a fixed location and some initial expenses understand that you need to be looking at those expenses. But for an online or virtual business, you still do have website design and fees that you're going to have to pay. You're going to have to get some help on search engine optimization for your website. You may have to put up some money for advertising on the various social media platforms, whatever you're planning to do in order to publicize that virtual business. So that's the startup part. And she's got a pretty good chunk of money that she needs. $213,800 is what we've calculated here. For the fixed part of things, the things that are going to last for a long time, plus the things that will ultimately be repeating. Insurance will go on, and we'll see that in the operating expenses and some legal expenses. She's going to have to continue to buy inventory, as we'll see. She's going to need some working cash, just some money in the bank, money in her pocket in order to start up. So all of that comes up to $213,800,000. Okay. How about labor? What's the situation with labor once she gets going? So she's got the owner. She's going to pay herself $25 an hour. So her estimated payroll at $40 an hour, when you include taxes and so forth, is going to be $4,333. Full-time employees, she's going to have 3 against once she gets operating, and she's going to need those people right at the beginning, even before she brings in a lot of revenue, to grow the plants, to begin deliveries, to manage the order process and so forth. So we figured $17.50 an hour for those people, and that comes up to $9,100 a month. And her total salary and wages will therefore be $13,433. So on top of the pay, she's going to have to pay out Social Security, Medicare, taxes, unemployment taxes. I've given us, this is the Massachusetts state unemployment tax rate. It'll vary if you're in a different state. If she has any kind of pension plan or program for herself or for others, anything else, workers' compensation, insurance that she may have to pay, all of that in this particular case that we've calculated is in another 14.75%, almost 15%. And that's pretty typical. If you've worked for an employer as an employee, you've noticed some of this stuff on your pay stub. Your employer is paying half of your Social Security, and you're paying the other half. That's the biggest piece of it. But just the same, it all comes up to 15 to 20% for a typical business. And as the business begins to add benefits and gets larger, very often that grows to 25%. So altogether, she's going to need almost $15,000 a month in order to operate the business right from the get-go before she begins to have sales. And that's an important thing to remember. We're going to plug that number into the cash flow so that we can see how much money we need on an ongoing basis. I'm going to go back a slide just to make the point that she needs $213,800 to start the business, and then she needs $15,000 more or less to continue running the business. So we're separating out the startup costs from the ongoing costs. And that's what these spreadsheets will help you do. So now let's look at the operating expenses, the things that are not labor that will continue as she goes along, in addition to that $15,000 or so of labor costs. She'll have advertising, she'll have some car and truck expenses, some insurance other than health insurance. She may have some legal and professional services, accounting services, for example, and so forth. And you can see what we've done for her particular business. And again, for yours, you have to think about what the expense lines are for your particular operation. And I'm going to show you how to think about that shortly, and how to find information in order to do reasonable estimates. We'll get to that at the end of this webinar. Even now, you can sit down and scribble out, okay, well, what do I need? What kinds of things do I have for my particular business? That's what belongs in this spreadsheet. Okay, let's talk about sales and sales projections, which are the next thing you have to do. One thing that's really important to remember is that it takes time to get that first sale and more time to build sales volume. And so you have to be realistic about how long it will take you. If you think by the end of the first year, you're going to be generating $100,000 in sales, or whatever that number is, or let's take 120,000 because it's so easy to to take out per month. You're not going to have, in all probability, you're not going to have $10,000 the first month. You're going to have to build that business up over time. So in the first year, even though your end volume, maybe your end revenue may be $12,000, the total is not going to come up to 120,000. It hopefully will continue in the second year, and it will be that or more. But you have to be realistic about how long it takes to build up volume for the particular business you're in. So where do you get that? How do you find that out? Well, if you've worked in that field before and you're starting a business in an area that you probably know that already. But ask people who work in the same sort of business, who have done this before. And that's certainly a reasonable thing to have a conversation about, and build a month-by-month sales projection. That's really important. It's not just what you're going to do at the end of the year, but show me month by month. And you need to do that because you need to know how much cash you're going to need to fill in the gap between your revenue, your sales, and your expenses. And you will need some money in addition to the startup costs. And we'll show you where that, well, we've already seen where it's going to come from. It's going to come from labor costs and the ongoing costs that you have. But we'll spread that out over the year so you see the total and how it begins to change as you go through the year. So she has, let's see, we have here a question. Is this a virtual assistant? Okay, so I would say start with the first template, start with the startup costs, and then go on from there. So Anne has 3 categories of sales. She's going to sell direct to local retailers, and retail might be a store or it might be a landscaper. She's going to try to sell through representatives to distant retailers. So she's going to package up her plants and ship them off to people who don't live in the immediate area, or retailers who don't live in the immediate area. And then she's going to have some internet-based sales to end consumers. She's not going to have a storefront for consumers. That would be an additional operation that she doesn't want to start, at least at this point. And she doesn't want to compete with her customers, who are her main customers are florists and nurseries, tree nurseries that are going to be selling her product. But she'll have some internet-based sales to end customers, and they all have sort of different rates of cost structures and to service them, and different rates of getting built up. So if she's able to do some direct sales to local retailers right from the beginning, that bit of revenue will start up much more quickly than selling through representatives to distant retailers. She has to line up the representatives. They have to begin making their sales calls. That will take a little while. And the same is true of internet-based sales. That takes some time to build up. So let's talk about what it is that your sales unit is. She's selling a plant. But what are you selling? Are you selling a product? Are you selling services, either price per hour or a fixed price, or some combination of both of those things? What's the unit of sales that you have? And you want to determine your direct cost per unit and your price per unit. So you know how much to charge. And obviously, the price has to be higher than the cost. So let's look at her projected sales forecast. And she thinks that in the month of January, she's going to sell 6 units of 6 bags, basically, just getting the business started. But by the end of the year, she'll have sold a total of 125. And she thinks that her total sales, dollar sales, will be about $11,000 in that first month. And even though she's looking to have $250,000 by the end of the year. So a much higher level of sales per month. And her cost of goods sold, she pays for the product plus what it takes to sell the product is going to be about $6,000 or about $137,500 at the end of the year. And we'll show you how that all works out. And so that's her total gross margin. $4,950 is what's left after her sales less her cost of goods sold. Now that doesn't include the labor costs, her operating costs, labor and the ongoing operation. They still need to be deducted from that number. So now let's think a bit about, well, where do we get these costs? How do we find this out? You can certainly Google look for some numbers for typical costs for tree nursery or any other sort of business on Google, but it's not just Google. There are all sorts of places that you can get information. The people who are supplying you can help you understand what the costs are going to be. Ask them. You can learn from competitors, and you think, how do I learn from competitors? Well, if you're running a small business, there are going to be a lot of other people in that same small business. They may be located outside of your market area. They may have websites that you can find to look at how they're set up. You can walk in to even local competitors and take a look around and talk to people and say, I'm thinking about starting up. What do I have to know? And if you've already been in the business, that's, you have a huge advantage in all of this. But you can learn from other people who are in the business, even if you haven't been in it. And suppliers and competitors are the best places to go. If you have a competitor who's, competitors outside your market area, you're starting a local business in Springfield, talk to people in Hartford or talk to people in Boston or Worcester who are in that business, and you're not going to compete with them. You can say, I'm going to open up, I'm going to be in Springfield. I'm outside of your market area. Can you help me understand what the startup costs are going to be and what my ongoing costs are going to be? Sales volume in units. So you can estimate how much sales am I going to get? So what's typical in a business like this? Again, you can learn some of these things from suppliers who say, well, this is the level of product that I sell into this particular company in the business that you want to be in, or competitors. How big are they? What do they look like, and what can you figure out from the size of their business, in terms of figuring out how many sales units they have, what their sales volume is. But you may be able to get estimates from news reports, from your work in the industry, from, as I say, observing competitors. Trade associations are a great place to go, trade or professional associations, because they pull together data from all of their members, and they have publications. They have a website. Typically, you can have a conversation, perhaps with somebody in their office to help you get a sense of what it takes to start up. Trade association is worth joining. And you can learn an enormous amount, especially at the beginning. So you want to estimate the sales volume that's needed to make the business profitable. And you can get a lot of help with all of these numbers at the Kirstein section, the business library of the Boston Public Library. If you go into the Boston Public Library, the Boylston Street entrance, not the great grand entrance that faces Copley Square, but the much more approachable entrance on Boylston Street, and go downstairs, there's a business library called the Kirstein section. It used to be a separate building. It's called the Kirstein Library. And there are people at the reference desks there who will help you find this information or tell you where you can find it. And they can be enormously helpful in getting all of these numbers together, whether it's information about how much it costs to rent space in downtown Fitchburg, or what it costs to hire people, what the labor costs are typically in downtown Boston. So let's see if we can get some other thoughts about what we need to know here. One is, how fast am I going to have to pay for the things I buy? And how fast am I going to get paid by my customers? If all of your business is online, you're probably going to get paid right away by somebody with a credit card. There's a cost to that credit card. There's a charge. 3% is typical, 3-4%. But you're going to get your money right away. If you're buying online, you're going to have to pay right away. And if you're buying from a supplier and the supplier will give you 30 days to pay, that's fairly typical. Then you have to figure out what that means for your business. So in Ann's case, we're going to assume that she's going to get paid within 30 days by 30% of her customers, between 30 and 60 days for 30%, and by 40% in more than 60 days. You're going to take a little more time. And so you want to watch that, because numbers that sit in your accounts receivable, the money that you're supposed to get from your customers, you don't want those to get too old. You want to get that money in as fast as possible, because you're going to need it to run the business. And she's not going to make any allowance for bad debt. That's probably not a particularly good choice, but okay, let's leave it there. It just simplifies the calculation a bit for what we're doing. But if you think you may have customers who don't pay you or don't pay you for a very long time, you need to consider that. Again, if you're doing business online or everything is credit card business, you don't have to be concerned about that. And the next thing is, okay, how do I pay out for my supplies? And in Ann's business, she's going to work with suppliers who will give her terms of between 30 and 60 days. So she says she's going to have to pay everything out between 30 and 60 days, but she doesn't have to pay it right away. Some businesses, some industries, that's typical. In other industries, you'll have to pay more quickly. But in any case, the total should add up to 100%, and the template will insist that you do that. And then, okay, where do I get my money? How do I get this thing started? And so she's going to put in some money herself. She's saved up some money from perhaps working in this business previously. She's going to put $115,000 into this. She hasn't got any outside investors, but she's got a commercial loan of $33,800 and a commercial mortgage on that land of $50,000, and she's going to get a loan on the truck that she needs. Remember that it's $20,000 that she's going to pay, but she's going to get $15,000 of that on a loan rate. And here are the loans, the loan rates. And these are pretty high rates. Probably right now, they're not so unrealistically high. In the past, these would have been lower, but interest rates have gone up and will continue to go up probably for another year or so before they begin to settle back down. So you have to be realistic about the loan rate that you're going to pay. And these are typical commercial loan spread out over over 7 years, a commercial mortgage over 20 years, a vehicle loan over 4 years, and you might stretch that to 5, 6, 7, depends. And however you put that in, the payments will be calculated out here. So you remember that we said she needed $213,800 worth of startup capital. This is where it's coming from. And there are some ongoing costs that go into her operating expenses over here in the payment side. So for existing businesses, there's another section of that spreadsheet, what your accounts receivable are and prepaid expenses that you've already paid for, that will tell you how much cash you've got on hand to get started. It's the bucket of cash plus receivables that will be turned into cash, minus payables that have to be paid out in the near term, that is in the first few months of the plan. Okay. Next is cash flow, and this is a really important thing to do. And we're going to walk through this in some detail. So cash flow is is a look month by month at how much money comes in, how much money goes out, and how much is left over. So it's like a home budget. You know what you're getting paid, how much money is coming in, you know what it costs for rent or mortgage or taxes or food or whatever. Those are all of your ongoing expenses. We're going to do the same thing for this business. So we're going to say that as her business gets started, she's going to be selling plant mix. Those are the bags of stuff that she's going to sell at $10,000 a month when she gets started. And then as the summer begins to build up, it's going to grow. And then people go on vacation and she thinks that things will drop off in July, and then they'll resume in August, and then gradually they'll drop back down at the end of the year. She's going to have $250,000 of sales for that category. It's going to take her longer to begin to sell this stuff on the internet. And she's going to start off slow, probably 4 or 5 months before she gets going. So she has $5,000 in the first month, and then it slows down a bit in the summertime. And then she's hoping that it will build back up, expecting it will build back up to $57,000 by the end of the year over here. And for her plant mix to sell to distant nurseries through her reps is going to take that much longer to start up. And there you see the sales that she's expecting from that. So where do you get these numbers? Again, you get them from talking to people, or from your own experience in the business, or from doing some, asking some questions of, or getting some information from a trade association, or for looking for typical business plans that may be published online. And there you would have to go to a librarian, a reference librarian, and you can certainly, if you can walk into Kirstein, or you can pick up the phone and talk to them. The people at the reference desk there will help you, as will other local librarians in any of the big city libraries, Springfield, Worcester, Providence, wherever you are. So total cash receipts. It's the sales from all 3 of these products by the end of the month. And the first month, it's only, she starts off with $41,000 of cash. You remember that's what we said way back at the beginning of, that's what she needed in the bank. As her startup, is the startup bucket that she needed, she's going to have $51,000 in receipts and cash on hand, but she has to pay some things out. So she has to pay for labor, payroll and taxes and so forth. She's going to pay out $13,000 in that month. And you can see month by month how this goes. So she builds up her sales as time goes on, so that the cash available is what's left over after all of her expenses in that month. And then the new cash coming in. And you can see that it goes down from $51,000, and it levels out after about 3 months, and then it begins to build back up. And that's the payroll and taxes part of things. So that's the first bite at the cash flow. Now let's take the second look. Operating expenses. You remember we said that we had ongoing operating expenses. They're back here. Let's take a look at where they are. There they are, $4,300 a month. So that's the second look at her cash flow. And that goes on each month. Doesn't matter how much she has in sales. And the next thing to look at is all the other expenses that she has, the commercial loan, the commercial mortgage, the vehicle loans. And those gradually decline as they get paid down in the case of the vehicle loan and the commercial loan, and the mortgage similarly. So her total other expenses are $13,000 at the end of the year, but you can see how much they are each month. And she doesn't actually start using her line of credit, her cash line of credit from the bank, until February, and then she begins to use more and more of it. So it builds up towards the end of the year, and then it begins to tail off. She can pay some of that money back. So all of her expenses come up to $18,511 at the end of the first month. Okay, let's go back. And we can see that she's brought in only $10,000 and she's got $18,000 going out. That's why she needs that cash on hand at the beginning, because this pattern is going to continue for a few months, more going out than coming in. So here we see what's going on. When all of these expenses get added up, she started off with $41,000. By April, she's been losing cash because her revenue hasn't, her revenue and then her what's left after revenue have not been as high as her expenses. And so you can see that her cash declines. And she has a cushion here of $17,000. And then in May, it begins to pick back up. And the cash begins to grow back up so that she's got $160,000 of cash at the end. And she's probably going to pay herself a bonus out of that because she's been only taking $25 an hour for her labor. And she may pay her employees something as well at the end of the year. So we haven't put year-end expenses, any particular special year-end expenses in here. But the important thing is all these 3 pages of cash flow go together. And it shows you that you can expect in a typical business startup to begin by losing money in the first several months, and then turning the corner and beginning to build cash back up. And that's probably the most important single thing that you need to recognize when you're starting a business is you need that opening cash of $41,800 in order to get your business off the ground, because at the beginning your expenses will exceed the amount of money that's coming in. So let's take one more look at that bottom line, and you can see what happens. Gradually, it starts off with at $41,000. It's down to $15,000 in March, begins to turn around in April, actually, not in March rather, not in April, and then it builds back up. Now, why does it build back up in this spreadsheet? Well, it builds back up because her sales are going up, right? And you can see in May, in April, she doubles their sales from $10,000. And in May, she doubles it again because she's beginning to get some traction with her selling. And it goes on through the year. Okay. Sorry. There we go. Okay. So that is the whole package of what we do. Looking to understand the expenses that we have right at the beginning, the startup expenses. So back to the start, this is what she needs altogether. That's the operating capital, the dollars and cents that she needs to run the business and still have a little bit of cushion back in March and April when she's at a low point. She needs altogether $213,000. Where's she going to get it? Well, and here's the labor costs and operating expenses. Where's she going to get that money? Oops, sorry. Here it is. All right. Here's where the money is going to come from. She has to work out all of that in advance, all the loans and bank debt that she's going to have and so forth. Hopefully she's not going to use any credit card debt. It's very important not to use credit card debt because the loan rate on that, it says here 7%, but that's way below what typical credit card loans are. That's the most expensive loan that you can get, other than doing something outside the normal channels. So why bother? Well, to go through all of this, it helps you figure out whether the business will enable you to reach your goals. It tells you how much you're going to need to start. In her case, $213,000. not a small sum, but she's got some cash to put into it herself, which helps in getting a bank to give her some money. It gives your whoever it is who's helping you with the rest of that money a sense that you know what you're doing, and that they'll have a chance of getting their money back. It gives you a sense of what your development startup costs are going to be and your ongoing expenses, and gives you a plan to follow. So she has to be looking back at, well, have I made those sales numbers? Because if I haven't, I should modify my plan, or if I've done better, or my expenses have gone up or down, I should change that projection so that I have a realistic projection going forward. I do want to talk just briefly about where to get funding. The classic place for a startup is family and friends, because banks, generally speaking, will not give a loan to a startup business. There are, however, nonprofit lenders who do that. And if you talk to a SCORE mentor in each one of the chapters around Massachusetts and Rhode Island, the mentors in each office will know who the nonprofit lenders are that service their area. Very often, neighborhood development corporations will do that. And then there are some nonprofit lenders who lend more broadly across the Commonwealth of Massachusetts anyway, and I'm sure that there are similar organizations in Rhode Island. And so money will come from family, from a nonprofit lender. If you have collateral, if you have something against which you can get a mortgage, for example, you're buying land or you're buying a building, or you own property, you may be able to mortgage that property. It's not a loan to the business, but rather a loan based on the collateral that you have, on your ability to pay back based on the piece of property that you own. So it's possible to get some bank financing if you have something that the bank feels they can rely on in order to make a safe loan. The key thing that a lender wants, whether it's a nonprofit or a bank, and sometimes family, is they want to make sure they can get their money back. And they'll wait. They'll charge you interest, and they'll wait and they're happy to get their money back over time, but they want to see that you've done a projection that shows that they can get their money back. And they'll think about, well, is this projection realistic? So you have to go in there with a realistic projection yourself. Okay. We have a question. I'm a travel advisor. I work from home, get paid on commission. I get paid after the client has their activity. That is, once the vacation has been completed, and there's about a 30-day gap between the end of the vacation and the receipt of the commission. And he or she, Lynn, okay, she splits 50-50 with her agency. And that's very typical for a travel agency. She has some fixed costs. What modifications might I use to make this workable for me? Well, that's a really good question. So you're already there. If you're thinking about starting your own travel agency, that's a little bit different, but let's go back to the beginning and take a look at that. So you don't have any of these fixed assets. You're already, you're working at home, you've got your house and your telephone in place. And if you're going to have your own website or anything of that sort, those are your some startup costs for building that website. You may have some of that, but you don't have a lot of this startup stuff. What you do have is working capital on cash on hand has to cover your ongoing expenses before you get those commissions. So that's where that accounts receivable estimate comes in. And you know that there's a 30-day gap between the end of the vacation and your commission. There also is some time between when you book the vacation and when the vacation is taken. So your accounts receivable is stretched out pretty far, and you have to be as realistic as you can be about that based on your own experience. Let's look at the next one. You're not going to have employees, but you want to pay yourself. Okay, so you have ongoing living expenses. You want to make sure you cover those, and you'll be, if you're doing it as a self-employed person, you have to pay your self-employment taxes, and that actually gives you higher numbers for Social Security. You double these numbers that you have to pay for yourself. So, and operating expenses, you may have some of these, but the major expenses are website, if you have that, and telephone costs and so forth. Those are the fixed costs that you're right. The key thing that you want to look for is probably down here, accounts receivable and accounts payable. So you have to modify this to be realistic for your particular kind of business. And so I've gone through that for Lynn in the hopes that all of you will see that you have to, this particular thing can be really important depending on the kind of business you have. If you're selling software online or selling something on Etsy or something of that sort, you get your money right away. There are people who have to wait a long time for their money. And if you're in that category, it's really important to figure that out because that goes into your cash flow estimate. It's how much money am I actually getting paid? So now where you would modify things is in this cash flow thing, it's cash receipts, and it's, vacations from 2 months ago, 3 months ago, or whatever where you're getting your commissions. You have to recognize realistically what the flow of that money is, and plan accordingly to have cash on hand to cover your expenses in the meantime. So I hope that is a good answer, Lynn. And if you have, I'll let you say if you want to. No, I need some more information about that, but I hope that's helpful. Any other questions? I don't see any others in here. Here we go.
Yeah, we got a couple in the Q&A tab.
Okay.
Does an LLC or sole proprietor have to pay business taxes if they never collected a payment from customers and if they never profited?
You have to pay. So business taxes are taxes on profit, and then there are taxes on the labor costs that you have. If you're an LLC or sole proprietorship, you're going to file a Schedule C on your tax return, and if you have what's going to happen is that the profit that you have, well, if you've never profited, there's no profit that's going to flow over into your 1040. So the answer is no, you're not going to have to pay anything. If you've paid other people, then you'll have to pay Social Security taxes for them. But you can't, in the first couple of years, the IRS will let you deduct the expenses that you have for your startup business. But then after, I think it's 3 years, you have to show a profit. Otherwise, they won't let you do that anymore. They won't let you do the deductions anymore. So the short answer is no, you don't have to pay business taxes if you don't have a profit, but eventually you have to have a profit and will have to pay business taxes, or you won't be able to deduct your expenses. A program like Quicken, will that help with filling out these reports? It might help somewhat. If you have a record of prior expenses in Quicken, then sure, that would help a great deal. If you've used, there's another product that Intuit sells that is more of a heavy-duty accounting program. That takes some effort to set up, and so Quicken might be a good place to start for a small business for this sort of stuff. It'll certainly help you keep track as you go along. So if you set up a Quicken account for an ongoing business and use it properly for incoming money and outgoing expenses, then it's a great way to track things and a great way to, looking at a cash flow statement, figure out how I have to modify it as you go forward.
Yeah, and you're referring to QuickBooks, and QuickBooks has
QuickBooks is the alternative that Intuit has.
More robust business reporting.
Right.
Yeah,
we have workshops on QuickBooks. At the very beginning, I would be cautious about using QuickBooks, and certainly be cautious about trying to use it yourself, because it's not an easy thing to learn right on your own right from the beginning. But if you want to take a workshop in it, and there are some templates that QuickBooks has in it for various kinds of businesses, those can help. But Quicken is, it's a place to start. And that's it. So this is in hours. We set aside an hour for this, and We have no further questions. Anybody, if anybody else has any questions, if you send them through to Teresa, she'll forward them to me and I'll be happy to answer them. And we'll send you out these spreadsheets. That's about it. Teresa, anything to wrap up?
I mean, I definitely already attached the spreadsheets into the chat along with the presentation. I also gave the link for the recording. So give me 24 hours to get that recording up. But we do have all those questions covered. I do see we have somebody with their hand up.
Sure.
Jason, and he asked the question in chat. He's asking about a lightweight version called Wave.
Oh, that's from Danielle in the chat. You got it. Okay, Jason.
Okay. All right. We're good.
Yeah,
Okay.
It's an alternative to QuickBooks. There are both Quicken and QuickBooks have alternatives that can actually be pretty good. Don't just settle for the big brand. Take a look around.
Yeah. Okay.
Okay. Thanks very
That's
much.
all we have then. Thank you, everybody.
Bye-bye.
Bye.